Well, there's been a lot of talk lately about whether this latest move in gold and silver is finally the game changer everybody's been waiting for. So in this video, we're going to separate the noise from the signal, and by the end of this, you're going to have a much clearer view of what's actually happening, what probably is not happening, and why this setup matters a whole lot more than one good day on the chart. Today is Monday, April 13th in New York, and before we go any further, comment the day and date you're watching from. And real quick, if you value the way I break this stuff down, support the channel by subscribing and commenting John A.G. Best. That really helps more than you know. Now here's the basic story making the rounds. Tensions cool a little bit, markets catch their breath, and instead of precious metals fading back into the background, they start firming up again. A lot of people look at that and immediately say, there it is. That proves the bull case. Nothing can stop it now. Maybe. But slow down. That's not actually the most useful way to look at this, because what we just went through was not some clean, textbook, one-direction move. It was messy. It was emotional. It was liquidations on one side, safe haven buying on the other, dollar strength for a stretch, then relief buying when the pressure started to ease. And if you try to reduce all of that to one headline explanation, you're probably going to miss the real opportunity and the real risk at the exact same time. So let's start with the first big idea. The recent weakness in gold did not automatically mean the long-term case broke. In fact, in stressed markets, gold can do something that confuses a lot of people. It can get sold right when the world looks scary. That sounds backwards, but it happens all the time. Not because the metal suddenly stopped being useful, but because traders and funds don't sell what they hate first. They sell what they can sell. They sell what still has a bid. They sell what can raise cash fast when other positions are blowing holes in the boat. That's the part a lot of people miss. In a rush for liquidity, even strong assets can get clipped for a while. If people are dealing with collateral pressure, forced de-risking, or a dash into cash in the dollar, then gold can wobble even while the bigger reason for owning it is getting stronger. That sounds contradictory, but markets love contradictions. They feed on them. And silver? Silver adds another layer of drama because it's not just a monetary metal. It has an industrial personality too. So when fear and growth expectations are fighting each other in the same week, silver can look like it had 3 cups of coffee and no sleep. It can overshoot both ways. That's why I'd be careful about treating every silver spike like a final breakout trumpet. Now, does that mean the move we're seeing now is fake? No, not at all. It means you need to understand the engine. A rebound after liquidation pressure fades is real, but it is not the same thing as saying the market has entered some frictionless straight line higher. Those are two different claims. One is reasonable, the other gets people in trouble. And this is where the bigger framework matters. The long-term bull case for gold has not been built on one ceasefire, one war headline, one jobs report, or one scary week in equities. The deeper case has been about confidence, reserve behavior, debt, currency management, real rates, and the slow recognition that the global system is not nearly as stable as the glossy headlines make it look. That is why the official sector matters so much. Based on recently published numbers, central banks were still buying heavily through last year, with total official demand in the mid-800s of tons, and February this year still showed net buying rather than a retreat. That's important because it tells you this has not just been a retail story, not just a momentum story, and not just a panic trade. Big institutions with long-time horizons are still treating gold like strategic reserve insurance, even after a historic run. And I want to pause there, because that point gets abused in both directions. The bulls abuse it by acting like central bank buying means price can never correct. That's nonsense. The bears abuse it by pretending official demand doesn't matter because it isn't the whole market. That's nonsense too. The adult view is this: strong reserve demand does not cancel volatility, but it does give the market a deeper structural floor than it had in older cycles. That matters a lot. It also means that when gold pulls back for technical reasons, you have to ask whether the pullback changed the structure, or whether it just bruised sentiment for a minute. Those are not the same thing, and in this case, I lean toward the second explanation. Now let's widen the lens, because the real warning in this whole discussion is not only about metals, it's about the kind of world metals are trying to price. One of the biggest unresolved issues is energy. If shipping through that key Middle East corridor does not normalize cleanly, if the war premium sticks around longer than traders expect, or if regional politics keep supply nerves alive even after the loudest phase of the conflict cools down, then oil doesn't have to explode forever to do damage. It just has to stay elevated enough, long enough, to squeeze the consumer, pressure margins, and keep inflation from falling the way policymakers want. From recent energy forecasts, crude surged to around $100 in March, and the official outlook now assumes prices could stay unusually high through this quarter before easing later, with traffic through the strait only gradually improving and risk premiums sticking around. That is not a small detail, and the policy crowd knows it. Minutes from the central bank's March meeting said a persistent rise in oil prices could keep inflation elevated longer than expected. So even if the war headlines get quieter, the economic aftershocks do not necessarily get quiet on the same schedule. That's a big deal for metals. Why? Because if growth slows while energy stays annoyingly expensive, you get this ugly cocktail where consumers feel weaker, businesses feel tighter, and inflation relief comes in slower than hoped. In that kind of environment, hard assets don't need a fantasy scenario to stay relevant. They just need trust in the paper system to wobble a little more than expected. But here's where I'm going to challenge a lazy assumption. A lot of people hear higher oil and instantly jump to, therefore, precious metals straight up. Not so fast. Sometimes higher oil is bullish for metals because it keeps inflation anxiety alive. Sometimes it's messy because it strengthens the dollar for stretches, tightens financial conditions, and makes everybody sell whatever they can. So again, you've got to think in layers. The medium-term case can strengthen even while the short-term tape gets mean. That layered thinking becomes even more important when you get to private credit. This is one of those topics that sounds boring until it isn't. As long as credit is plentiful, people treat private lending like a clever workaround, a smarter pipeline, a more flexible engine. But when the cycle turns, the question becomes very simple. Who is really holding the risk? Who is funding it? And how quickly can the stress travel? According to recent research from the New York Fed, bank exposure has not fully left the system, because banks still sit behind parts of the private credit complex through senior loans, warehouse lines, and other funding links. In other words, risk can move around the room without ever truly leaving the building. That doesn't automatically mean a giant systemic blowup is around the corner. I'm not saying that. But it does mean you should not dismiss the area just because the label says private instead of bank. Hidden connections are exactly what make late-cycle markets dangerous. Problems rarely stay in the neat little box they started in. And the timing on that matters, because the broader economy is not exactly sprinting. Recent government data showed real growth near stall speed late last year. And the latest labor report showed payroll gains in March, yes, but also an unemployment rate in the low fours and payrolls that have changed very little on net over the prior year. That is not a roaring backdrop. That is an economy with less cushion than the headlines imply. Now add one more force to the mix: artificial intelligence. This is where people get way too binary. Either it's magic and saves everything, or it's overhyped and changes nothing. I don't buy either extreme. The more believable version is that it boosts productivity in some places, creates demand for technical talent, and quietly takes a bite out of routine white-collar work before society fully digests what's happening. Labor projections and related analysis from the federal statistics side already point in that direction. Stronger demand for software-related roles, but weaker demand pressure for parts of administrative support, sales, arts, and other routine task-heavy work as automation spreads. So when you put it all together, you do not get a clean inflation story or a clean deflation story. You get a tug of war. Oil and geopolitics can keep price pressure sticky. Credit stress and labor disruption can lean the other way. Growth can soften. Policymakers can stay reactive. And that is exactly the kind of messy middle ground where investors start craving assets that don't depend on a perfect economic script. There's also a geopolitical portfolio angle people should not ignore. When governments feel boxed in, they spend. They spend on defense, on supply chains, on domestic energy, on grid upgrades, on strategic stockpiles, on industrial policy. That does not mean every stock in those themes becomes a winner overnight. That is one reason I think the conversation about selected non-US exposure deserves more respect than it gets. Not because America suddenly stops mattering. Of course not. But because parts of Asia and parts of the emerging market complex are no longer the flimsy, one-dimensional story some investors still picture in their heads. In a world defined by tariffs, resource security, manufacturing realignment, and power demand, some of those markets may have cleaner balance sheets, more favorable valuations, or stronger strategic tailwinds than people assume. That does not mean buy blindly. It means look with fresh eyes. And while we're at it, let's deal with another emotional trap. People love the phrase secular bull market when price is rising, and they forget what the word secular actually means the moment a correction shows up. A true long-term bull does not glide higher in a smooth elevator ride. It lurches, it resets, it shakes people out, it humiliates the impatient. You had excitement wearing a tie. That's especially true in metals, where sentiment swings hard. One month everybody wants exposure. The next month they say the move is over. Then a few weeks later they're back to talking about a historic breakout again. That whiplash is exactly why your framework matters more than your feelings. And I'll add one more fresh point here. Recent international commentary has been pretty direct that the Middle East conflict can leave the world with some combination of higher prices and slower growth, even if the most extreme scenario doesn't happen. That is a nasty setup for traditional 60-40 thinking because it muddies the path for both equities and long bonds at the same time. So no, I don't think the right response is to chase every green candle. I think the right response is to recognize that the macro backdrop is still unstable enough that defensive assets and real assets deserve to be taken seriously, not treated like a relic trade. That brings us back to positioning. If I were thinking about this the way a serious investor should, I'd separate the portfolio into two buckets. One bucket is tactical, the other is durable. Tactical means what might work over the next handful of months if the market is mispricing policy or growth. Durable means what still makes sense even if the next quarter looks different than you expected. Gold fits the durable bucket for me. Selective gold miners can fit there too, though with more volatility and more company-specific risk. Silver can fit, but I'd size it like silver, not like cash in a vault, because silver can turn a good thesis into a bad experience if your sizing gets reckless. I'd also keep an eye on parts of energy infrastructure, utilities tied to power demand, defense spending beneficiaries, uranium, and select international exposure, where valuations and policy setups are not as stretched. Not because every one of those trades wins at once, but because the world we're moving into looks more fragmented, more capital intensive, and more security focused than the one people got used to. On the tactical side, I understand the appeal of short-dated sovereign debt over sitting in dead cash, especially if too much tightening is still priced into parts of the developed world, while long-duration bonds remain vulnerable to fiscal pressure. I'm less excited about reaching way out the curve and pretending government borrowing math doesn't matter. It matters. And through all of this, remember something simple. Don't root for chaos just because you own metals. A broken market is not some fairy tale ending where your screen lights up and everybody claps. Broken markets come with freezes, rule changes, ugly liquidity, bad spreads, tax surprises, and governments suddenly getting very interested in what you own. What you actually want is repricing without disorder, strength without seizure, opportunity without panic. That's the goal. And if you're successful, share your success story in the comments so others can stay motivated. So is this the game changer we all anticipated? I'd say this. It could be a major turning point, but probably not for the simplistic reason most people are repeating. The bigger message is not that one bounce proves everything. The bigger message is that the world still looks vulnerable to reserve diversification, sticky energy risk, fragile growth, hidden credit links, and labor market disruption all at the same time. In that kind of backdrop, precious metals do not need perfection. They just need the old assumptions to keep cracking. That's usually how the really big moves begin. As always, this is here to help you think more clearly and ask better questions. It's for education, not personal financial advice. And before you put real money to work, make sure the plan actually fits your risk, your timeline, and your life.